guys are interested too, let me know. Send me an email.
I follow. You know, it's clickbait for me. I'm always interested. I'm not in it at all, but it's fascinating.
Oh my God, George Clooney joining us today.
I think he's making his way through Ocean's 11 cast. Maybe. I think I got it, Jason. I think I see what you're doing there.
I have no idea what you guys are talking about. This was me the other day at the opening.
Oh, okay, cool. Good to know.
Like your work from home look. Casual.
Like twins. I have no idea what you guys are saying.
Are we supposed to take off?
All right. Very good.
That went smoothly. Excellent.
Yeah, did we get everyone?
I think so. I exited out. Yeah, don't forget to close your Remo tab, by the way. In case you had left it open on your computer, just close the tab so there's no feedback.
All right, great. You guys, is it noticeable that you can maybe hear me better? I got this new headphone system. Sweet, right? I'm going to start using this for my podcasts. Doing a cheap commercial for, if you guys have heard of Halo Talks. No, I'm just kidding.
That is the Halo Talks microphone, though.
That is. It's the original. It's the original. No upgrade. Straight up original.
It's the good one.
Yeah. Okay. All right. Let's get rolling here. So where is Ayers is ready to go? All right, Steve, you want to kick us off here and give us your 3 takeaways from WeWork?
Yeah, so I don't count real well, so I think I got 4.
Okay, 4's good.
Number 1 was trust the data in the balance sheet. Growth is not a strategy. They fell to the bias of past performance as an indicative of future performance. Number 2, money hides a lot of problems. No corporate, maybe limited oversight. They just kept throwing cash at it. Old statement is bet on the founder, but for the right reasons. They bet on a guy with vision, confidence, and grand ideas of disruption. They left out a few things like integrity, professional discipline, and fiscal responsibility. Number 4, and lastly, if I'm going out to do an APA or a share agreement, I'm hiring this guy to do my deal because he got one heck of a deal for himself.
Well, that deal never got done, but he definitely swung to get it done.
He got him a jet.
Almost got him. Almost shoot it in under the rug.
He got a jet.
Got a jet. Okay, so here's what we're going to do. I'm going to bring up a couple of slides here once Dave gives me access. So let's start with table number 1, which is the Blue Hens. Barry, do we have you in the did WeWork's lights go out maybe? Is that what happened?
Can you guys see me?
No, we can't.
Peekaboo. Hold on one second.
Oh, there you go. Whoa.
All right. Hello.
WeWork didn't pay their utility bill for a second.
That wouldn't surprise me after all the stuff we've read and heard about. All right. So we are the Blue Hens. We have a $1.4 billion endowment. Thanks to Pete. And all that money printing is going somewhere. I guess it's coming to us. So we were tasked, our team of 5. Pete asked us if we would invest in Silver Lake. Our answer is a yes. We would invest 50% or $700 million into their fund. We feel that given their 20+ year track record in investing, their stellar success they've had overall, that we would feel comfortable allocating this percentage into their future.
700 million, half of your whole endowment fund?
Yep.
Oof, that's a lot. Okay.
Yep.
All right, next. Oh yeah, go ahead, Barry.
I would just say they're not perfect. I'm sure we all heard about the Russian hack with SolarWinds, which they own, Silver Lake owns, and probably even dumping $300 million in stock like 2 days before the hack was announced, which may suggest insider trading. I don't know. So we probably heard about that, and they're not perfect, but it was perfect. So a lot of money.
So for the amount of money, you're either going to turn into the dark blue hens, or you're going to turn into the silver hens if you're going to put half of the endowment in one fund. So it's a strategy. So let's go to Sarah.
So I'll jump it. So I'm going to start with the disclaimer, Pete. They tried to buy ABC. I'm under 2 NDAs with these guys, so I'll say some things. I'm not going to say some others, but great experience. 1999, you got to look at tech, 386 computers, BlackBerries, and low-speed internet, right? So we said we'd give them 5%, 300, and I think it's 350 million.
Okay. All right. Sounds good. All right. And University of Michigan, table
We
number 3.
we decided also to we're going to give a little bit less than 5%, 100 million of our 12.5 billion. We like the team, but we hedge our bets and believe in diversification.
Got it. Okay, so University of Delaware, and look, I mean, there are asset groups that go heavy with a couple of different private equity firms. There are groups that just invest in Blackstone. There are groups that just invest in KKR. From an allocation standpoint, it's heavy, right? Because in the private equity, we looked at it's probably like 20% goes towards private equity in total. But the conversations that you just had, which were literally 10 minutes, is the same conversations that actually happen inside of these endowment funds. And what they do is they get the prospectus, which is, a 100-page document. They hire someone to do a background check on the 4 founders. They typically ask for what's your deal sheet or what's your track record. And then they do in-person meetings and kind of flesh out whether they feel like there's that they like the team. Investing in anyone's first fund is like investing in someone's startup company. So, you got to think about a lot of first funds do really well because they've tapped into an asset class such as these guys have that nobody else was going after. So it's an interesting thing to be able to invest in, but at the same time, they don't have a proven track record yet. Sometimes when you don't have a proven track record, you can get the best returns. So, as we think through this case here, what were your impressions, Sal, to start with you, of these 4 guys individually and then, as a group?
Well, we were talking about it in our classroom earlier. I mean, this was like the dream team. When you go through everyone's background, it seems that they were able to pluck people that were on top of their game in various, Wall Street firms. So I really like that. I just said, man, what a group of A players that they had. Also, I like that they had, they're going into tech, and obviously tech was, it was an interesting time. And I think Steve's comments earlier about where we were with technology, I think we forget how far we've come since 1999. But I had a tremendous amount of faith in those guys. And then at the same time, what I'm realizing is the egos that are in this world are just incredible. And I have to say, it would have been hard to say no to those guys. They were pretty darn impressive to me.
Mm-hmm. Frank, you've been around a lot of investment bankers and asset managers in the past. Typically have great pedigrees. Look awesome on paper. So give us your unfiltered view.
Well, that's a good question, Pete. Look, I mean, I think, and again, these guys talk the game where at the end of the day, it's not all about the money, it's about the relationships, but at the end of the day, it's all about the money. So, and these guys, for the most part, run pretty hot, as far as that's work is what they do, deals are what they do, and it's all about turning the profits. Even the ones that talk about long-term, long vision, which Silver Lake talks a lot about, is, hey, we're in this for the long game. But at the end of the day, it's still about turning the profit.
Yeah. Ed, you've been around a number of different private equity professionals in the past. Do these guys strike you as like the new age or the new culture, or maybe just similar, in different clothing?
Yeah, what I would say is the people I have been around were kind of like in Little League, and these guys are the Major League Baseball players. I mean, these guys are the real deal. I've been around the small time ones who as somebody already said, it might have been Sal. They had egos that were pretty huge. So I can't imagine the egos on these guys. Even though Steve was was kind of saying their mode of operation is not to come in and take over everything and run everything. It's really to provide support and let the team that's in place use those supports to do better, which I thought was interesting.
Yes, let's do the math here. So you got a $2 billion fund. I don't know if they disclose this in certain areas, but it's a 2% management fee on $2 billion. Okay. So if we do the math on that, if you agree to this investment, you're basically paying these guys 2% a year, okay, to run money for you, right? So if these guys get this money, this full $2 billion, it's a $40 million, and each one of these guys could at least take $5 million a year and then build a bench of analysts and associates and VPs. So, Eyal, would you guys at University of Michigan, would you try and cut a different deal with them and say, hey, look, guys, your first fund, I'm not paying you 40 million. This fund shouldn't give you 40 million. We should do this on 1% and 10% of the upside instead of 20%. Or do you think they had enough inertia to say, if you want to get in on this, it's on standard terms?
What I'll say is, first of all, I just want to clarify, we put in $625 million out of, which is 5%. So it's more significant than the 100 million. I don't think this is negotiable. Based on what I read, they were oversubscribed. They didn't need my money. They had what, $20 billion more to choose from.
And how do you know that?
Well, I mean,
do you ever know it for a fact?
You'd be more inclined to know this if this information can be, due diligence can be done on it. But if someone says to me, this is non-negotiable because I don't need your money, I'm inclined to believe them. But I also want to know if the mayor of my town, I want to know if Stanford's in. I want to know if Harvard's in. I want to know who else has committed their money.
Okay, so now you're talking about what we talked about the other day, which is like this fear of missing out that some of these groups, like you mentioned last class on Jamie Dimon and SoftBank, and it seems like everyone was doing their diligence, but if one got in, the others kind of followed. Roger, you've been around private equity as well. If they say they're oversubscribed, it could also be like a landlord saying, hey, I got 5 people looking at my site, and you got to sign the lease. So don't think that there's like an elevated level of integrity when they say something is oversubscribed. So what's your thoughts on these guys? And do you trust them?
My approach, I think of the difference between negotiating and navigating is that in negotiating, you change your position, and in navigating, you change your perspective. And so I'm rooted in what I stand for. This came up in our breakout room that I'm sort of living through the aftermath of what happens when private equity goes wrong right now in my current role, because private equity we're beating the drums behind TSI and pushing it to grow, and they're in it to make money, and I'm in it to help people. And if we make money, then that's a reward for doing it. But that's not why I'm in it. And that's just a benefit. And so it's a different perspective. Neither is right or wrong. I'm good with it. But when I'm going in and I know that that's their position, then I'm going to be a little bit more careful. And I'm not going to just jump. I'm not going to fall for the, I'm not going to go for the takeaway close, right? Like, oh, well, you better get in, or no thanks.
Yeah.
Right,
so look, I've been doing this 22 years. I don't know a guy who's ever told me his fund's been undersubscribed. Doesn't happen. Okay. We either hit our target or we were oversubscribed, right? Frank, you can appreciate that. Like there's a lot of ego in the room here, right? So Emma, to you, why don't they call their last names like a law firm? Why they come up with a generic name like Silver Lake, if the size of the egos and the fact that you're investing in, these 4 amigos? What do you think?
I'm just trying to unmute. What did they do? They named it after wherever they were skiing at the time. I don't know. Everyone seems to pick a nice thing. I guess succession. I guess there's advantages and disadvantages of having names involved. I mean, obviously, yeah. I mean, you can palm it off. You can evolve it. it could go either way. I mean, they were the Four Amigos, they were famous. People can vote for and against that. Yeah, I guess Succession, and then some of them outed and moved on pretty quickly. So they probably know that it's a bit of a game for a while.
So let's assume that each one of these guys is a good team player. I don't know any of them personally, but let's say also they're in the business of protecting themselves, their assets, and their careers. Okay. So Doug, if you were one of the Four Amigos here and they said, hey, let's put everyone's last name on the door, you know, what would be how would you feel about that? Would you feel a sense of loyalty? Would you feel a sense of like, now you have loyalty? Everyone has loyalty because their name's on the door.
Right. Yeah, absolutely. I mean, you're putting your name literally to the success or the failure that comes from the investments and the choices that not just you, but the team makes. So absolutely.
So we're talking about how much money we're going to make. Okay. And these guys might be around a room and be like, you know what, dude, we better fucking protect our downside because I do not want my name in a newspaper on the title of the article that says we did XYZ to this company, or this company went into bankruptcy and now we got our 4 last names plastered all over, you know, the internet, right? So you also got to think about like, oh, the upside and the downside of that. And there's also obviously benefits to the succession side of it. But these are things that go on in the back room. And I'll tell you a story here. I actually want to go off, stop record for a second, Dave. So when I first worked in private, you know, and some guys put their name up and they're willing to stand for it and some guys aren't. So look, you know, these guys obviously have been successful. They've raised all these funds. You know, who do you think they're, you know, Jenna, who do you think, you know, where would you stop first if, you know, or where would be the first couple of stops that you'd make if you were trying to raise this fund?
Like,
what kind of like investment groups or endowment funds or pension plans or?
yeah, I mean, I'd probably go, like some of them look like, I think I read they're Harvard grads. I'd probably go to my alma mater, try and be like, hey, come support us. Maybe and obviously have bigger funds and probably some other universities.
Right.
It's kind of hard.
Yeah. So you'd hit all the top players. So probably, you know, University of North Carolina at $6.5 billion and up would be your target to get this money. So look at the size of these capital commitments. Tom Richards, I mean, what do you think? These returns look good. There's some group that allocated, I don't have their earlier funds, but you know, $480 million in their fund 3. So what are your thoughts here on these returns? 18, 23, 32.
I mean, they look great, and people seem to have a lot of confidence, and they're investing, and they got off to a great start, and they've kind of just continued it right along.
So we know from the funds that we were talking about in the first class that they were looking at like a 7% hurdle rate. Does everybody remember that? Okay. So Emma, if you remember the first class, we talked about one of the largest funds in the country and how they had so much assets to invest. In our state of California here, CalPERS is our largest investor in Silver Lake. Okay. So if you remember, CalPERS is invested in all these private equity funds. They're invested in all these real estate investment trusts, and they're invested in all these different equities. So now CalPERS is now invested in Silver Lake. Okay. So to kind of make it as simplistic as possible, every time Silver Lake does a deal, they send a fax back in the day, and they say to CalPERS, hey, you're an investor of 10% of our fund. So you have to send us 10% of this deal that we're doing. And we're funding this deal at the end of the month. And you got to send us a wire for $30 million. Okay. So when you think about all this money is the pension and teachers fund of the state of California, which has $380 billion that their fund is. And I just got to dance for them for a second if you want to take a quick dance break, because like CalPERS is all over the industry. And I remember this little baby here. So CalPERS is funding all these guys to go out and run money. And they're behind the scenes and they're trying to make their 7%. So to your point, Tom, yeah, these returns look great because, yeah, I got, I need a 7% return and you're, giving me these really big returns. Steve Ayers, you've been around some of these private equity and venture firms. What do you think when they're going to raise the next fund and they go to CalPERS and they say, hey, look, you put 200 million in or 480 in the last fund. Look what I did for you. How do you think that negotiation or discussion goes versus the other assets that are in the CalPERS portfolio?
Yeah, you're gonna go for more. You're gonna go for more, and then you're gonna push a higher return. The interesting part, though, when these guys were investing early, there's nothing else in this fund. That's what makes this unique. When they're throwing money into equity now, they're throwing money into hedging. These guys were all into tech, so it's either go or bust.
Mm-hmm.
That was an interesting part of it, because you look at these funds now, they do have some diversity, even though they're specialized. These guys were not at the time.
Yeah. So Stoll, when you take a look at the returns that these guys put up, and they were basically the first one to this big tech LBO party. Do you think that that's sustainable, or what do you think happens over time or as this grows?
Well, assuming, again, in the beginning at the time, it seems pretty risky. Ideas are cheap, execution is everything. And so I think you look at these four guys and you look at a budding tech industry. I mean, I think, you go for it.
So John Miller, why do you think the private equity funds of the past didn't invest in big technology companies?
Well, I think, like you said, it was these guys brought a new perspective to investing, and somebody made the comment that these guys were recruited. In reading the case study, I didn't get the sense that they were recruited. I got the sense that they came together and they only did this because they felt like they could work together in the way that they did. I also feel that because we're talking about egos,
mm-hmm.
and the fact that they invested in tech the way they did was unique. I got the impression that if egos are the norm, that was something else about these guys that was different. Is that I get the sense that they're actually a pretty humble group. And we were commenting in our little breakout table that, these guys' attitude was to keep the management in place and work with the existing management, as opposed to take the quick return by cutting costs, by, sending current management down the road. And I think just that attitude speaks towards humility as well. Now,
mm-hmm.
I could be saying something that is totally off base. But that's just the sense I got as I read about these guys, that, and it may end up being their greatest asset is they're not operating based on ego. They're just grounded people making solid decisions.
It's possible. So Barry, you cover a lot of private equity funds and you help them bring on management teams. What are the types of companies most private equity groups that you work with buy? Or what industry categories or like complexity of the business?
All consumer. Our equity clients look only at consumer, specifically within health and fitness facilities and also restaurants. Most people want to work out and everyone has to eat.
All right, let me stop you there for a second. Doug, how hard do you think it is to diligence a consumer product that you find at Walgreens?
How difficult?
How difficult is for you to understand what the company does, or like if they have
straightforward.
Very straightforward. Okay, private equity started in New York City. Okay, the guys that started the private equity industry knew nothing about technology. All right, one of the guys I mentioned that I worked for before, when I said, let's go into let's do goldsgym.com. He's like, I have no idea why you can't put an apostrophe S in the URL. So I can't invest in it. I don't understand the business. Okay. And a lot of private equity firms actually put in their documents 25 years ago that they specifically would not invest in technology and they would not invest in real estate. Okay. We're going to go find middle of the road companies that are industrial companies or consumer companies or services companies, and we're going to help them grow. We're going to put some debt on them, and then we're going to try and sell them to the next guy. All right. So if somebody sat down, like let's say me, if I sat down in front of CalPERS and they said, "Oh, you just invested in a semiconductor, chip manufacturer, tell me about the history of that industry." Or, what's the technology risk, or what's the product life cycle? I have no I have no idea, right? But I do know that there's this shampoo brand that I could buy out of out of Procter and Gamble that's been clipping along at, $40 million in revenue, and I'm going to put in a chief marketing officer. I'm going to put in a new brand packaging, and we're going to do some product extensions. We're going to do facial creams, and we're going to do brushes and facials and things like that. That's like middle of the road. So the private equity groups of the past did not understand technology, and therefore that's one reason why they didn't invest in technology. Okay. So it was an underserved market based on Excel, because everyone who works in Manhattan knows how to do a leverage buyout model in Excel, but they don't know what the curve is, or, blade technology versus cloud computing. We just don't know that stuff, right? So that's one of the things that happened. So in the other part here is, in 2001, there's another story I want to tell you real quick. I want to start a software company, and I went to one of the guys, and he's like, "Look, I don't understand this whole internet thing. I'm not sure why you think it's such a big deal." And I just put an acronym down here. And he said to me, "I think your enthusiasm for the internet has clouded your business judgment." Okay. And this was like a really well-respected private equity guy who bought industrial companies, agricultural tank business, aerospace parts brake business, because the brakes go out on a lot of airplanes. So they got to replace the brakes, so you take the private equity community and try and say, "Hey, what do you guys know about technology?" And they're like, "Not much." And I have zero interest in knowing it, because I'm going to stay in my lane. Okay. So when the Silver Lake guys come around and say, "Hey, I'm going to go do LBOs on technology companies," people are like, "Wow, that's interesting," because no one's ever brought me that idea before, right? No one's ever had the sophistication to actually pull that off. Okay. So, if I go, let's go, Ed, back to you here, so where does this kind of stack up, in the tech growth LBO? And, as these guys got traction, obviously there are other groups that formed. Do you think they've created a franchise in that? And that once they do a couple deals, maybe they get first look at some of these other companies that want to do it?
Yeah, I think it's easy looking back saying absolutely, because that's kind of what happened, right? There's these groups out there all over the place now. I also think way back then, and I'd have to think about it a little bit, but there was a lot of talk about value investing back then, and growth investing wasn't as big. And I think certainly over the last 20 years, there's been a big shift more towards growth, and tech has helped that.
Yeah. So, basically the playbook here is, we're going to buy these companies, right? And obviously, what these guys had was they had access to deal flow, and they had people that could call the CEO of a company, and that should never be discounted. If anyone on this call ever wants to talk to, the top 10 CEOs at a health club chain, like that's what I do. But when, think about these guys saying, "Hey, I'm going to call, I'm going to get on the phone with the CEO of Sun Microsystems. I'm going to get on the CEO, of Microsoft." Like, these guys were in the room as a banker or a buyout fund or an executive, and that gave them access to buy things and potentially buy them right without an auction. Then they're going to optimize the company, they're going to grow it, and then they're going to try and sell it, or they're going to try and IPO it, and they're going to give their money back to CalPERS. They're going to keep that 2% coming in, that $40 million a year for 5 to 10 years. And then they are going to keep 20% of the profits of that. So, if I look at these brands here, what are your thoughts, Sarah, on these three brands? I don't know if SunGard's a little bit, dated, but, investing in Dell or in Skype, like, how does that feel to you as a risk return?
I think it's a complete home run. I mean, good for them. I think we all interact with these companies, if not now, a couple years ago. I think Zoom kind of replaced Skype, and obviously Apple did a number to Dell, but I mean, great. That was clearly worth the risk for them.
Yeah, Frank, looking back, thinking about Dell, was probably the market leader at one point, then kind of, lost its way, but still a huge company. So what are your thoughts here when they say, hey, we're going to go buy a technology company? Is it big enough to the point where like the word technology isn't synonymous with risk?
Just to say that one more time, Pete. I'm sorry.
I'm saying like once a company gets big enough to the point where they've got an established business and they're doing $5 billion of revenue, even even though it's a technology company, like to you, does it kind of cross the chasm that it's not as risky because of the size?
Yeah, look, I mean, there's obviously a level. I mean, it's a mature business to a certain extent, right? It's kind of gone up that plateau from a revenue standpoint, and there's some maturity to it. And so, yes, I think it does cross that chasm. And then I think they saw that they, versus a typical mature company that might decline, they thought they could probably, they saw other opportunities to go to a different level with it.
Yeah. So, when we take a look at this, let's just kind of tick through this here. Tom Richards, anything on here from a standpoint of what big companies have that you kind of identify if you go in right away, what you do to help them on any one of these 6 boxes or all of them?
I think all of them. If I had to prioritize, well, people management system would be, maybe the top priority, infrastructure and their technology, but cash flows, depending on their situation. But I can make a pretty strong case, I think, for all of them could be a top priority.
Yeah. So Steve, when you've looked at other companies or larger companies, what does a cost structure look like of a company that's been around for 20 years? Do they, what's their, how do you think about their overhead and their infrastructure?
Most of them are inflated, and a lot of that is due to just growth and how the people have grown with them, but also his experience. What I found is when these guys came in the companies I've been involved in, is they bring such experience. If they've made that mistake or done that before, you can actually shrink staff because you can share services and knowledge with these guys. They shaved a lot of cost off
They take a lot of costs out. So this is, think about this firm Silver Lake coming in, and they've got access to other deals that have happened that they've all worked on. So, 15 years of experience times 4, right? So I got 60 years of looking at companies to the point where, like with Roger working at New York Sports Clubs, like you kind of know where the bodies are buried. You just got to go and kind of, get your shovel and figure out why they're there, and start getting job descriptions of people to find out like what they really do during the day. And you realize that there's a lot of cost in a large company. And also companies sometimes lose their way and don't run the kind of analyses that financial people do when you're outside the company. So you might say to Dell, hey, that's great that, you selling these personal computers and you're advertising online for that, but your business segment is way better than your consumer segment. Like, don't try and compete with like Gateway Computer, just let them have that. Let's just go business enterprise. That's recurring. Okay. It's relationship-based business. So they change the way you think, and they typically have a pretty good strategic plan in place. Now, the interesting part about the health club industry, and what I want to look at here, go to Sal for a minute. The areas that are highlighted are, this is in 2013. Lifetime Fitness was kind of the bellwether, or like the best company in our industry, right? So it had all this cash flow and income from operations. So say like take the 2013, sorry, 224 million, 624. Sal, for everyone here that didn't know, LA Fitness, when they came onto the scene, what was the sentiment around them?
Oh, they were coming in. They were going to dominate the world. I mean, that was it. And what they were is they would build this beautiful box, but only charge $34 for it. And So, and they
Sorry,
would go in.
this is Lifetime. This is Lifetime.
Oh, I'm sorry, you said LA Fitness.
Yeah, I misspoke.
I'm sorry.
About it. So this is
It's
Lifetime,
okay.
building $40 million boxes.
Right. Okay. So Lifetime, when they came in, I thought what they did is they developed a luxury YMCA that appealed to families. And it was, in my opinion, that middle class, upper middle class, amazing country club. The value was just great for the family, and I thought that they appealed to women and kids. And if the kids are happy there and the wife is happy there, that membership is not going anywhere. So I guarantee they had some of the best retention rates in the industry because of that.
So everyone loved Lifetime Fitness. They built these $40 million, Taj Mahals of the health club industry, turned it into, the JCC or the YMCA, but, almost like an urban or suburban country club, but Doug, when you look at the CapEx that this company spends and how much money they have to do to grow, how do you feel about that? Just these numbers at the, on the second row.
Well, they're look huge. I mean, that's the second most that you're going to spend is on your people, and then it's your rents. So, to have that level of service, you've got to pay.
Right. So I got big rents, but I've also got, like, if I want to build a new location, I got to spend so they spent $359 million in 2013 on building more boxes. Right. So there's no free cash flow in this business. All the free cash flow is going towards growth. Right. Now let's look at Dell Computer in 2013. And Jenna, since you're our certified accountant here, the $3.3 billion of cash flow and only $513 million. So when you look at this kind of financial statement, they obviously don't need to build. They don't need to spend money on building an operation. They can basically just add more manufacturing facilities. So
Yeah.
What's your impression here of the two?
It's just, that's kind of the beauty of technology, is the margins are so much better than anything brick and mortar related. And once you, obviously economies of scale, as you get things, you can, pay less when you're ordering more, and the more you grow, your costs become cheaper. You just get better at what you're doing. That doesn't really happen with a brick and mortar because everything's the same price. You can get a bit of price cuts, but you're always going to be spending a large amount, and you have to bank on making that back. So I like this a lot better.
Yeah. So look, Dell Computer kind of lost its way. People are like, oh, this isn't, as awesome of a company. Well, hold on. It's actually spitting off $2.7 billion of free cash flow. So when the guys at Silver Lake say, hey, look, maybe we can go and do something here, because if we could just tweak it a little, there's a lot of cash that could either pay down debt or that we can use to do other things. We could potentially do some acquisitions, so when you take a look at the business model, what they were really selling, the CalPERS and University of North Carolina and Michigan and University of Delaware say, look, people don't understand this business, right? Investors don't understand the business. We understand it. We've been around it. And these other private equity deals that you're doing, they got to put so much money into their cost that we actually have way more free cash flow. So when someone says in this page here, someone says, okay, Lifetime Fitness, to put you on the spot, Steve, does that sound like a 10 times EBITDA deal, 15 times EBITDA, if like the value of the company?
No.
It doesn't.
No.
Okay. All right. So this company was valued at like 15 times EBITDA. Okay. But nobody actually did the math to say, well, 15 times EBITDA, what about all the CapEx? Like it's actually negative free cash flow. Okay. And then I look at Dell and I say it's 2.7 billion, but if the 2.7 billion, that's actually like real money that like flows out of this business. So I can actually go and I can put debt on this business because I know I can pay the interest, right? So these guys kind of figured out, like, one, I got big companies that have a lot of things that I can do with it. They got a lot of cash flow. People don't understand it. I do, right? So I'm going to go invest in this, but I can't go and raise a $200 million fund. I need like $2 billion because I got to go get some of these bigger companies. Because if it's instead of Dell Computer, it was MindBody when it had like $20 million of revenue. there's a lot of risk in a $20 million business. There's less risk in a you know, a $2 billion or $4 billion revenue business. So that's kind of the game that they were playing here. And what they did was they basically figured out, you know, I could put debt on these companies when no one else thought I could, right? And the banks didn't think so either, because they're like, oh, there's a big technology risk. There's like, well, there's actually not as much technology risk when it comes to like a PC computer or a monitor as you think there is. All right. So if we go back to our returns analysis here, Doug, I'll harken back to you here. When we looked at the returns between doing a all equity deal and a deal that has some debt on it, you know, give us a little refresh on the benefits of that or the risks.
You got me here, Pete.
Okay. All right. No worries. Frank, hit me on the returns, just on putting debt on the business.
Yeah, I mean, it's again, I just look at it simply, Pete, like you're buying a rent house, right? You put down as little bit of money as you possibly can, and then the renters are paying the rent, which is paying your debt service on it, and so you really have, you know, very little capital at risk, but over time, the asset pays for itself, and then ultimately provides a great return based on the investment made. It's a pretty high return.
Got it. Okay, we're going to cover two more things here, and then we're going to take a break. So check this out. What these guys also were doing was they were putting in minority equity stakes in a company. Now, if I put a minority stake in your business, my money is ahead of yours. Okay, so if a owner of a business has a company, it's $1 billion company, you know, Silver Lake comes in, we put some debt on the business, we put our preferred, and then you're below me. Your rollover equity, if you remember that from the past. So if we take a look at this for a second, this is really important, then we're going to break. So got $100 million of EBITDA. Let's say someone, an owner of the business says, yeah, I want $1.5 billion, Silver Lake, and I'll do a deal with you. You say, you know what, let me think about that. Do you have any CapEx? Very little CapEx. It's $100 million of EBITDA. It's really $100 million of cash flow. Like, you know what, I'm going to go to JP Morgan and see if they'll loan me $200 million to buy this company. Okay. And then I don't actually want to own control of your business. I actually just want to I want to grow with you. I'm going to put money into your company to help you grow. Okay. So they go, let me just go back one. So Silver Lake comes in and they say, okay, well, look, we're going to put in $500 million into the business. You can either take it as a dividend out to your investors or to your family. And then your 800 is going to be below me, right? Does any questions on this so far? So we paid 15 times for the business. I got 2 times from the bank. I put in 500 million. So in a worst case scenario, okay, if this company gets sold in 5 years for 7 times, I get my money back. All right. Now, if I own majority control of the business, then I've got the entire 500 plus the 800. Okay. So now if this business is sold for $1 billion and it goes down, my investors like CalPERS just lost $500 million. I'm probably not raising another fund. Right. So let's say, Steve, you had a comment. Okay. All right. So now we look at it and let's say they come back and say, you know what, I'm not comfortable doing a deal at 1.5. I got to do a deal with you at 1.7. You might say, okay, I'm going to keep my same 500 million in, but it's going to be ahead of yours. Okay. So I'm going to ride the growth of this company. And in a downside case, I get my money back as long as the company is clear 7 times. So what people use as a term is how deep am I in the cap structure? Or how deep am I in the capital stack? Okay, so they're putting money into these companies. The owner's like, yeah, I got 15 times for my business. I brought in Silver Lake. I got 17 times. It's like, yeah, but they get their money out before you see another dollar. Okay, so this is some of the special sauce here where I'm going to ride the growth of a technology company. And on the downside, I'm probably getting my money back, which is really what CalPERS, University of North Carolina, Delaware, and UNC really care about. Don't lose my money. So this is a way to get involved in high growth stuff that has very little downside. We're going to take a break and I'll see you in 5 minutes. Capital stack on how these guys invest.
Yeah, 90-10, 90% debt, 10% of the equity is the norm. And
Yeah, not that much on a, hopefully it's more like 60-40, but you slide in kind of right ahead of the entrepreneur and right behind the debt, and you're in a nice safe place overall.
I found that part to be very interesting. Like, that's a really smart thing, is I'm been over the past few years been more involved in deals where, and I see these the cap table stacks start to build up, and you see people are jockeying for position in there like it's the Olympic marathon.
Yeah,
and,
I mean,
and so that's a really smart move to put themselves in there where they mitigate risk, but they're probably going to get all the reward too. Smart.
Yeah,
like we're not talking about them because they're not good at what they do.
Right. Yeah. Well, one point, Switch Playground in New York, we had to close because of COVID. Well, maybe we'll reopen or not. But we had a group of investors that put $1.2 million into the company and had $11 million of money into the company beforehand. We put our $1.2 million in as our preferred equity behind like $100,000 Amex loan. So like we're the first $1.2 million out. And that's material right now because that would be probably 80 or 90% reduction right now, and if anyone would buy it. So having that preferred equity, that preference is definitely when you need it, it's awesome at the end, because you also got to look at it and say, hey, you had me invest in your company, you showed me some projections, you didn't hit them, shouldn't I get my money back before you get more money? Because you didn't do what you said you were going to do, which is another benefit of being a minority investor, because you could also have some plausible deniability that something wasn't your fault, because I didn't own majority control of this business, right? I just invested in it. They made some wrong decisions that I couldn't control. So some interesting nuances to minority versus majority controlled deals, but one is like a principal preservation is really important.
So is that what everybody goes for? Tries to get the preferred?
Yeah, you rarely see deals, early stage deals, like every private equity deal that gets done, unless there's some nuance with an owner or a management team, they'll always have a liquidity preference, and they'll just say like, look, my cash is worth more than your quote unquote like enterprise value that you're bringing to the table. And then when you see all these deals that happen on the venture capital side, like this group put in a Series A, this group put in a Series B, this group put a Series D, right? It's all help me with this, Jen. Is it last in, first out, right? So the last dollar in is the first dollar out, right? So the Series D group always gets their money back before the Series C, B, and A, right? So everything's a capital stack on top of it, unless it's such a hot deal that someone's like, well, look, you got to invest pari passu or alongside me, or else I'm not letting you into the deal, okay? But there's really not a good counter argument if I'm putting money into a company to fund your growth that you've convinced me you can execute on, why I shouldn't get my money back if that doesn't work. So, but everything is a negotiation.
So are you recording right now?
I don't think so. Well, Dave, are we? Just turn it off. Ganlin,
So-
are we recording? We're off. Off? Stop recording. Yeah, we're off.
So these guys, when you think about tech, their book was all about tech, but
Talking about this capital stack. So if you do Series A, ideally you're going to want to contribute to B, C, D, all those series, so you can still kind of stay top of mind. Is that usually people's strategy?
So a lot of investors just say, look, I'm an early stage investor. I only do Series A and Series B deals. And when it gets bigger, I want Silver Lake to come in, or I want some other private equity fund like Battery Ventures, or like GI Partners is in the Daxco deal. Actually, I got them right here. I'll put this up real quick. Typically, if you're an early stage investor, you stay in early stage. You don't just continue to feed the company, because it's at a different risk return. So the way the Series A investors make their money is hopefully that if the Series A, let's say, was done at $10 million valuation, they hope the Series B is at a $50 million valuation, and then it goes to 150 and 200. So they get diluted every time. Their percentage ownership gets diluted, but it's a smaller percentage, a much larger number. So that's
Okay.
how all these venture groups look at it.
That makes sense. There is because if there's no upside, why would you go in Series A? But yeah, that makes sense. Okay.
Yeah. And then there's some groups that say I want to take risk, and I want to, and other groups are saying I want to take the most risk, which is at the start. And other groups are saying after you prove out the model, then I'll invest in it. And that's more of a private equity deal than a start venture deal. Any other questions on that?
So Pete, as you kind of go down the stack of the series, are those early stage investors getting their money back off the table, et cetera?
Typically not, unless it's a hot deal and the group that comes in wants to own more of the company and quote unquote clean up the cap table. So if you're going out, I mean, it's also the optics of it. So if you think about, if you had Lawrence, venture partners, and you came to me with this great idea and you said, look, I own 20% of this, software company. You should put the company, we need $20 million into this business. And by the way, buy me out at the same time. It's like two different messages. So you want to say, hey, look, this company is going to be bought by Google. We need 20 million. We're pricing it up because we got from here to there. And then you hope that they come back and say, hey, look, Frank, let me take you out because, we want to actually own more of the equity of that. But if you lead with that, it looks like you're trying to dump the company on someone. Does that make sense? Okay, cool. All right. So let me go through a couple slides. We got a friend of mine who went to business school. His name is Mirza Baig. He runs a venture capital firm. He's going to join us in 17 minutes. I'm going to rip through a couple other slides. Ayala, did you have a question before I started? I can't hear you.
All right, so you're a young hot buck who just graduated HBS. You have experience, I don't know, at DLJ or Houlihan Lokey, not sure, but did you know these guys? These four cats? Were they?
I didn't know them directly. They were not in my orbit or my age, so they were older. But they were at firms that like was stated by Ed. These guys were at the top of their game at each one of their firms. So.
Now you look at someone like DreamWorks, similar kind of situation. You have three all-stars, right? I mean, except these are all-stars. You did know Spielberg, you did know Geffen, you did probably know Katzenberg. They were
great analogy.
$2.7 billion like that, and ultimately they sold off the company without much success. They were still able to make a crap load of money.
Yeah, fair point. Okay, so here's what I want to do. Can you guys see my screen yet or no? Do that one more time. Sorry about that. All right. Okay. So as we as these guys start to get success, success in any business begets competition. So the rest of these groups started to show up at the party, and now instead of Silver Lake coming in and saying, "Hell, let me put money into your company. We're the best group to work with." We did the Dell deal, we did the Skype deal. We're basically, like lighter fluid on your company. Like, we're going to get you to the next level. We're going to sell you to Microsoft or Google or Oracle. All these other groups came and said, hey, that's probably a good idea. Let's go and do that. So, even just in our industry, our Halo sector, you've got big private equity firms that are very similar to Silver Lake that have recognized these companies are big enough. It's a scalable software model. It's recurring. It's highly fragmented. And I'm going to buy these companies, I'm going to grow them, and I'm going to do add-on acquisitions. And, I'm going to hope to either IPO it or sell it at some point. Let's go to back to Steve for a second and, comply by your NDA. But, once a group gets involved here, what are some of the internal changes or just generically that you feel as an employer, as an executive, and how things maybe get modified of how you look at the business?
First thing I've always seen is a change of control. I mean, they want, now there's an expense. So you have to go through before you can do any type of capital expenditure, spend any dollar, you had the ability to do 20,000 in marketing. Now you have to go through the controls. The cut was unbelievable in the disciplines to the balance sheet. I think you take a company like an ABC where we were at, it was success and you just kept running with your gut. Now they brought in disciplines. Hey, we run this, we're a big business now. You're a $650 million business and we're going to run it like one. You have It was a difference, a big difference. And same with GI. GI is the same way. Everything runs off a formula.
Yeah. So, Ed, your comments on, related to private equity coming in, or, if you buy a business and think of yourself as kind of, you're kind of the private equity guy, what do you start to do?
I start two spots. You look at cutting expenses as much as you can, right? What can you get by adding, taking away some of their HR and using the HR you already have in place, or the finance, whatever it is. So some savings there. And then, what can you do to drive revenue as much as you can, as quickly as you can?
So when these companies come in, there's a two-part movie. The first part of the movie is we're the best people you could ever find on the planet to be your investor. Okay. And that goes until the day of closing. And then when they own the business, you quickly realize, even if they have a minority stake, because you have to ask them, like Steve said, you got to actually get their consent. It's called negative controls, which is kind of a really interesting phrase to begin with. I have negative controls, which is like, Roger, you could spend $100,000 of CapEx as long as I agree to it. That's like a negative control. So you want to do something, and I just have to tell you no, instead of you thinking you could just do it on your own. So when these guys come in, they're thinking about your business in an Excel spreadsheet as much as they're thinking about it. What's your culture look like? Let me look at your org chart. How was your Christmas party? Right? They just look at the cost of your Christmas party. Right? They don't look at what that did to the culture. So, when you get involved in this game, that they're trying to, their objectives: one, I don't want to lose money. Two, I want to make as much money as I can as quickly as possible. Three, I want to kiss ass to all these fund managers, because they're going to pay me 2% of whatever I can push at them next. Right. So 2%, we started 2% on a $2 billion fund. Right. And we agreed that was $40 million a year. The 2% on a $20 billion fund is $400 million a year. Okay. That I haven't gotten my upside yet. Okay. So I just created from CalPERS, from UNC. You're getting a notice at January 1st. Ayal, Barry, and who's our third here? Who's our third? Emma. Ayal.
Sal.
Yeah, Sal. We're getting everybody. You're sending me money to run my business, to run money for you. Okay. So know that that's going on. I want to generate fees, and I want to get returns. Now, in our space, we had MindBody that got purchased. It used to be a public company, and then it got purchased by Vista Equity, which is very similar to, GI and Silver Lake and Thoma Bravo that bought ABC. And what they did was they did exactly what I had on this last page here, which was, hey, I am going to get some debt, and I'm going to put some debt on this company. Yet MindBody never really made any money. Okay. But there are these groups out there that say, well, this is a recurring software business, and if these guys are going to buy it for 1.9 billion, maybe I could give them, like 20% of the purchase price, and I hope in a worst case scenario, if they have to sell MindBody, I'm going to get my debt back, and then I could get paid some interest. Right. So if you're the banker that wants to loan money to buy MindBody, in the room, you're going to say, okay, if this goes bad, the Vista Equity, like Silver Lake, is going to lose like $1.5 billion, right? So they're going to do everything they can to make sure they don't lose $1.5 billion, right? And they're not asking for a personal guarantee, but they know that if Vista takes a write-off of $1.5 billion, that's a big problem for them as a fund. So that's why the debt gets put into these businesses, because they know everyone has a vested interest in trying to get this company sold. So let's go back to Barry for a minute. So, you got these institutional investors now, they got to go buy companies. They got a lot of competition. Feel free to opine on any of these boxes here of what are the other risks? Because this isn't, a risk-free, let's go find a company and go buy it and grow it for 3 years and then sell it and have a party. There's other factors that they can't control.
They're asking, what are the risks to buying a company?
Yeah, like what's outside of your control? Like you don't know who's going to be able to buy it in the future. You don't know a lot of different things. Just throw some out.
I mean, like a black swan event, like the pandemic, all the way to.
That's a great one. I didn't think of that, but I should have. Right.
I would probably even like the SolarWinds hack, like having all your data leaked and then all the government scrutiny.
Mm-hmm.
I mean, it depends on the size of the business, but and then state law, depending on where is your company incorporated, and maybe how tough is the state on certain aspects. Maybe even as simple as data privacy is a kind of a big one. It's very state to state. I mean,
So Jenna, what else would make you nervous if you were one of the 4 partners at Silver Lake? You buy this business, first couple of deals, you haven't really done anything yet, but you just bought it.
Yeah. I mean, is the technology going to still be relevant when I go to sell it? Like, is it innovative enough? What's the foundation like? Can I continue to improve it so it's relevant? And then obviously, did I overpay for it? Is the price that I've paid, is the market going to accept that later on when I go to sell it? I don't think liquidity is a huge issue with technology if we've already looked at the balance sheet, but then obviously public markets, how are they looking at the investment when I go to sell it?
Yeah, so you're wed to uncontrollable things when you buy a company. Could be the right time to sell it. You could try and put it in as an IPO, like the WeWork, or like SoulCycle, and they didn't get the IPO done because the market didn't like it. And the market didn't like it maybe because they didn't like the business, or maybe it just wasn't the right time. So as an example, we were helping a group try to raise capital in September of 2019. And it was a week after the WeWork financials came out. And this company was burning 2 million. Dave and I worked on it. It was burning like what, Dave, 3 million? No, 2 million a month.
Yeah, a little bit more if I remember correctly.
It was like 2 million a month. If we went out with that book 3 months before, we would have gotten somebody to just put $20 million into it. But because of the WeWork was in everyone's mind, and all the investors and everyone was talking about, there's no path to profitability, how they get to profitability, right? So now every meeting that you went in with a company that you're representing to try and get money, that's all they would say. What's your path to profitability? And like, well, we don't really have one right now because we didn't know that you wanted that. We thought you wanted to grow the revenue, right? I didn't know I need to have to also create a profit here. So now we have to go back. And at that point, like, you can't go back to investors and say, that plan I came to you 3 weeks ago, like, we're doing it completely different, right? It's because you lose credibility. But the reason why you did it was because you thought investors wanted to invest in high growth businesses without regard if they made money. So point is, there's a lot of things you can't control, and you got to time the market right. So these guys might be the best investors of all time. They also had very, very low interest rates. Okay. So CalPERS and y'all in your little groups there, you need to get your 7%. Right. And you can't put that into your bank account or a savings account, or, you can't do it much riskier investments because you might never get your money back. So it kind of came in at the right place at the right time, right after the .com bubble. And, they bought all these companies, and these are some of the recent companies. And probably at least half of these, right? So they're buying these big businesses. I'm not saying they're too big to fail, but you put money into Expedia, Airbnb, Twitter, Waymo, AMC, they probably lost their shirt on. But, Sophie, if you think of that one, when they put money into these companies, like we talked about before, they take these companies and turn them into monsters on their own because they have more money than everyone else. And at the same time, they put their money in preferred equity or in a later round, so they know that they're getting their money back. Okay. So there's always a story behind a story behind a story. All right. Now we got the current team here for these. This is the actual current team. Okay. I think there's only one guy who was the original team. So thankfully they didn't put their names on the door, because they would have to get new business cards every quarter. Okay. But now I got all these managing partners around the world. Okay. And I'm running this firm. So, John Miller, do you think because they were successful in the US that they have the right to go, invest in technology in other countries?
Well, I think they're smart too. I would think that their success in the U.S. would open a lot of doors anywhere they went.
Any other comments? Jason Stoll?
I think technology translates pretty well to most places. You're not going to third countries, so I mean, I would take that bet.
Okay. So if you're one of the 4 founders, yeah, Sal?
Yeah, I was going to say, international, if you're successful here in the U.S., you may not be successful in Germany. Yeah, you know what I mean? It's just, there's cultural issues. It may take you a while. So hopefully these managing directors are rock stars in those respective markets,
Yeah. So Barry, I'm going to go back to you. I'm coming with you with my 5th fund, and I'm doing a fund in Europe and Asia and the Far East, and you're sitting in Wilmington, Delaware, saying, do you like that? Is that like it's a little too much for me? Or like, what's your thought on that?
I would say, what are you thinking of investing in, and why, and who are the team?
Right.
What have they accomplished already?
Right. So the point is, I got to know who your team is, or I need to know that someone from your team is actually going over there. Roger, talk for a second. Go back to our industry on the health club side. Going into new territories and not really knowing what you're doing. Or what? That's probably good parts and bad parts to that.
Oh, I mean, it's. I look back when I was with Crunch and we went into the Atlanta marketplace. It ended up working out okay for us. We bought 6 gyms in the Atlanta market. Only 2 of them were really in locations where Crunch should be. And they did okay because we implemented our personal training programs there. But that was a little bit of arrogance going in there, thinking that like our brand was going to work in any market. And we ended up with a Crunch in Stone Mountain, Georgia. And I look back on that 22 years later, and I'm like, oh, how the hell did we end up in Crunch in Stone Mountain, Georgia?
Right.
That's it's like literally that town has a history behind it that is a complete opposite of what Crunch stood for with the no judgments philosophy. So
exactly.
we went in little arrogance and overconfidence. And a lot of it worked out okay, but it was definitely an issue, and it happens in this industry. I see a lot of that.
Yeah. So Tom, give us the sobering geopolitical view of just kind of like, hey, let's go do an investment fund in some country I've never been to.
Yeah, I think it definitely helps to understand the cultural competencies and to understand the government and the regulatory system and the relationships and who you need to know and who you need to not anger. All that would play into.
Yeah, I don't know if you have to do a bribe. I almost did a deal once with this guy in China, and he said this money goes to this bank account and this money goes to this bank account. It was like 10% of the deal goes to like the CEO. I'm like, dude, I can't. Grew up in Long Island, I went to Emory. I can't be doing that stuff, so there are different rules, right? So these guys just say, hey, we did awesome in the US market. Let's just go find a country and like hire 4 people. Like it's a lot more complicated than that. So when things are going great, and when they're not, it goes on fire. So let me bring in my good friend who I haven't seen in a while. Actually, Mirza, please join us.
Well, look, as young
What's
as
up,
you
baby?
me.
Good to see you, man. Wow, it's been a long time. Mirza and I were in the same. Mirza and I went to business school together in 1990. Graduated in 1999, Section C. So when you're in a specific cohort.
And you have to remember, folks, I remember Pete as like having this great set of hair, all black, and all of a sudden, who is this old man talking back to?
I did that on my own. I think I have to grow it back and maybe get some Giuliani coverage or something. Some hair
You look
color.
great.
Thanks, bro.
Great
Good
seeing
to
you,
see you.
Pete.
Thanks for coming on. Hey, do you want to just give like a 2-minute background or maybe more of your illustrious career, and then we'll fire some VC questions off at you?
Sure. So Pete and I met back in at Harvard, which was, 23 years ago. It's a long time ago. And I left HBS and went on to AOL. I did 2 things there, which was investing on behalf of the company. And we were the last investors in Amazon. I was the analyst working on Amazon, Stamps.com. Names you're not going to remember: eToys, Respond.com, things that just completely went bust. And then I left corporate America, became an entrepreneur. Became an entrepreneur for 10 years, co-founded 3 companies. And the last business I co-founded was actually Pete in your neck of the woods in Santa Monica. We built that business from 0 to about 140 million in revenue. I left with one of my investors. When we had built a business to about 18 in revenue, Goldman Sachs had invested 30 million into the business. So the partner from Goldman and I partnered up to start Allrich. So what we do today is we invest in what we call lower middle market, which is companies typically north of 10 million in revenue, founder-run businesses in second and third tier geographies, which all that means is not in Silicon Valley, not in New York and Boston, because that's where 80% of investment dollars go today. I was an entrepreneur for 10 years in DC. My co-founder was in LA. We thought we were pretty well-connected guys, and we knew how to get things done. But we had a tough time raising money, building teams, attracting. So we invest in people that look like us. So that's what we do today. And I'm based out of Washington, D.C. Swamp capital, as many people would know it. But great to see you guys.
Yeah, thanks. So, Merz, that's awesome. Talk about when Goldman came into the deal. You know, we just got off the tail end of a discussion related to minority investing and different series and how those negotiations went, and you know, like their liquidity preference and things like that.
Sure. So when Goldman came into the deal, my co-founder and I, when we were building our business in 08 and 09, this is my third startup that I was talking about. We tried raising money all over America, whether it was New York, Silicon Valley, everywhere. And we were losing a lot of money, but we were pivoting and growing our business 100% year over year. And literally no one would give us any money. All right. It was absolutely terrible. And then in 2010, the business was still growing. We went to Silicon Valley. In 1 week, we had met with about 20 different venture capital firms. On Friday, I was flying out. I had 6 term sheets in my inbox. And so we picked Goldman because I'd known the folks at Goldman for a while. And I just trusted the people who were going to be at the table with us. They were not the highest valuation, but they were folks that we knew we could trust, and they were willing to take a little bit of a risk on us because we were asking for some terms. We were trying to keep control of the business, and we got that deal done actually in 43 days from the moment they signed the term sheet to when it got funded. So probably a pretty record time, at least for me, it was record time.
Awesome. Hey, you guys want to fire off some questions? Yeah, Sal.
Yeah, Mirza, thank you so much for being here. I really appreciate it, sir. Real quick, the founder run, I love that term. What do you normally do when you buy this great company? Do you want the founder to stick around for a certain number of years? You want them to stay on? What's the strategy there?
So we definitely want the founders to stay around. In a typical business, in founder-run businesses, at least outside of the Valley, what you're talking about is 2 or 3 friends that came out of an industry, that know that industry fairly well, that have built a business. But 10 years later, one of the co-founders has left the business. The other co-founder whose heart is not in the business. And then there's the third co-founder, typically, that's actually running the day-to-day business. And that's the co-founder we want to make sure we keep, because that's the person that's built the culture, that's built the spirit of the business. And so we're typically doing is buying out the co-founders, putting some cash on the balance sheet. And if the co-founder who's running the business wants to take some chips off the table, we're helping with that as well. But our goal is very simple, and it's a very simple premise, Sal. when we invest, we tell the founders, we want you to stick around as long as you want and as long as you want to keep doing it. But our goal is within 18 months of investing, we want to double the growth rate. And that's, that aligns well with a lot of the co-founders that we deal with.
Awesome. Thank you.
Great. Ed?
Thanks for joining us tonight. The question I have is I see on your website that you're involved quite a bit in healthcare IT.
Yes.
And I'm wondering what you see in opportunities there, maybe outside of telehealth.
Mm-hmm. That's a good question. So the telehealth, I think everybody's thinking like Teladoc or Livongo, maybe some of the broader trends. So I think the real opportunity in healthcare is how do you help people stay healthy at home? That's the big white space that has still not been solved for, right? So if you think about Medicare, Medicaid, they spend $1 trillion a year in healthcare, and the codes that they have, the reimbursement codes, are they're being aligned with things like remote patient management or chronic care management. And and I don't know, Ed, folks, I don't know if you folks are how familiar you are with healthcare or not, and not familiar with healthcare, but majority of the spend is on the chronic disease side, which is really heart failure, diabetes, hypertension, COPD, or the last 6 months of a person's life. Between those two, between the chronic conditions and the last 6 months of a person's life, you're talking about 80 to 90% of healthcare spending in America. So, when I talk about managing something at home, it's managing these chronic conditions or helping some or folks who are sort of end of life issues, right? Managing those end of life issues. So that's the real opportunity. So in healthcare IT, we're focused on remote patient monitoring. I actually built the business I built that became that $140 million business. We were a teleradiology business. We were focused on helping radiologists read from anywhere, right? They can read from home. In the pandemic, this sort of evident, but back 15 years ago was not really the case. And then chronic care management. So those two things are sort of two big themes in healthcare IT for us. The other big thing is digitization of workflow, right? So across multiple enterprises. So in healthcare, maybe I'm getting too deep in the weeds here, but at a very simple level, it's digital transformation of pharmaceutical companies, clinical trials companies, billing companies, anywhere at hospital systems, practices, operating rooms. So all of those things that one doesn't necessarily think that are going to get digitized. I'll give you a simple example. If you're an anesthesiologist that is actually in the operating room, a lot of the work that you do is in a book. They carry a book around called, I think, a green book or a blue book, right? And they want to make sure they treat the right patient. So they'll take a photo and they'll take a sticker and stick it in that book. And then they got to enter that information manually into an EHR, electronic health record system, somewhere else. But that's you're paying a guy or a gal $300,000, $400,000 a year, and they're spending half their time on administrative items. That's what I'm talking about. The automation of that piece.
Thank you.
Hey, John.
Yeah, Mirza. Two-part question here. Number one is, do healthy people die less expensively?
That's a great question, because I spent a lot of time looking at that question. I was on board with Medicare of Virginia. It's a $9 billion. We spend 40% of Virginia state dollars on healthcare from state budget perspective, and I was the chair of the Fraud, Waste, and Abuse Committee. So this question of mortality comes up: is where is the money spent? Let me in a very simple way. Let me just explain. how I view this, and this could be right or wrong, but this is the way I look at it. People who are at peace with themselves and their families, those are the folks where the healthcare costs when they're in the last 6 months of their lives are not that high, right? So folks this stuff may be cliche, but folks that are spiritual, I don't care what your spirituality is, whether you're atheist or follow a particular scripture, folks that their kids have made, a lot of the healthcare spending happens when the kids are coming in at the very last minute and saying, I want to do whatever it takes to keep mom and dad alive, right? And the doctors are scared of lawsuits. I actually built a litigation business, so servicing lawyers and law firms. So folks are very scared of litigation. So they're like, well, I'll do whatever the kids talk to me about. But the kids were not involved in the parents' lives, right? So folks that have healthy family dynamics, folks that are spiritual, right, regardless of what scripture or a religion you believe in or don't believe in, generally speaking, their costs are a lot lower. And in America, we're very uncomfortable talking about death and the process of dying, right? So I was born and raised in India. And I always tell people, I came to America when I was 14. And I go back often, and I say, living in India is very hard, but dying is very easy because you have come to peace. You have made peace with yourself. And from the moment you die to the moment you're buried or in the ground or cremated is less than a day, less than 12 hours, right? Whereas dying in America, living is easy, but dying is hard, right? So because it's a painful process. When Pete and I were in business school, my mother passed away between my first and second year. And she spent 50 days in the hospital, and it was probably one of the most painful periods of my life. And now that I invest in healthcare, having built businesses, you see that up front. And especially from Medicare, you'd say, well, what's actually happening? I see all this great data, but I don't understand what the heck you're telling me. And you dig into it, and you end up realizing it's not necessarily the pedigree of the person, the size, weight, gender, whatever it is. It comes down to really those two characteristics that I'm describing.
Yeah. Well, I said a two-part question. I appreciate everything you said. You ever read Younger Next Year?
No, I'll write it down.
It's getting to be an old book, but I've probably given away 1,000 copies in my little town of Salem. I make people promise to read the first 4 chapters and give it to somebody else they know that can use it. But the guy starts a book with a graph of what it looks like to die in America if you're unhealthy, and it's this long, slow, painful decline. And if you're healthy, it's just a straight line. You're vibrant, and then you drop dead one day. So
Yeah.
Healthy people die as well.
Yeah.
But my point being is that intuitively, I feel if you solve for problem 1, which is the chronic disease,
Yeah.
you also solve to some extent for problem 2, which is the cost of dying.
Yeah. No, I think they're interrelated to a large part.
Frank?
So thank you so much for being here. I don't know if I have any just burning specific questions, but again, just appreciate your time being here tonight.
Great.
Steve?
So, and I know each deal is kind of different, and thanks for being here, but kind of in generalities, would you be willing to kind of explain your playbook of kind of when you go into a deal, what kind of debt are you looking to throw on the business? Kind of, are you on a 220 fee schedule? Kind of how the earnouts work? Do you have an overall methodology and playbook you run on every, or is every one specific?
So we don't put any. So good question. I refuse to put debt on any business. I have lived through 4 recessions, both as an investor and operator. And 08, 09, yeah. The one thing it taught me was I just don't do debt. So we don't do earnouts either. I was an entrepreneur. all my friends are entrepreneurs. I've never seen anybody get paid out in an earnout. So, having been on the other side of the table, I just, it's impossible. The ability to get an earnout is so hard. So we don't do earnouts just because I've never seen it work. We generally invest in what's called preferred equity. We've done minority deals, majority deals. I prefer majority deals to the extent that the co-founders, there's usually 3 people have owned the business and 1 is running the business, because they don't have control anyways to begin with, or 2 people are running it, or 1's running the business. We prefer to just be pure equity. Our average check size is about 41 million. The last deal that we were about to complete was about 110. The smallest we've done is 5. So it gives you a sense of the range.
Thank you.
Yeah, Barry.
Thank you for being here with us tonight. How important is it for you to, or how much time do you spend with the founder or founders to really get to know them before you consider an investment?
Quite a bit, quite a bit of time, because you have to trust those folks with so much. All right, and the biggest thing we trust them with is our reputation. We're a small firm, but we compete against the TAs and the Summits of the world. So the only thing we have is our reputation, and it's a lifetime marriage for us, because for every entrepreneur we invest in, our investors will call them and say, "How was Mirza in your deal?" Right? So one bad investment, one bad, I should say, reference could kind of stop a lot of things. And Warren Buffett had this great quote, and I subscribe to this quite a bit. He said, "I'd rather walk away from 9 good deals than do the 1 bad deal, because that 1 bad deal would ruin me." Right? And I think that's very true in the world of investing.
Raj?
Yeah, I will join everybody else. Marissa, thank you so much for being here. Some of the stuff you've shared is fascinating. The stat on people being at peace and spiritual, the difference that makes just in the cost. And it makes sense. I've had a lot of people close to me that have passed, and I've seen a lot of that. So fascinating to hear that. In my current situation, I'm not even 90 days into a new assignment. I'm running a large chain of gyms, 68 company just came out of bankruptcy, and we're in the middle of COVID. So we're dealing with a lot of things. I'm the CEO there. You've got a very impressive track record, and so I have access to wisdom like yours. Do you have any counsel for somebody like me? Some of the, without really knowing any more about the business, but just from the outside, some fractal management, like formulas, things to keep in mind that work just about in any situation.
So we actually built an operating playbook because we invest in so many companies that are very similar. So we've built an operating playbook, and we have what we focus on are 1 or 2 things each year that what we call are the vectors of growth, right? And each year the vector of growth could be different. But the one thing that underlies all of that is talent, right? So I know it's often said, and people talk about this quite a bit, but then having the 2 to 4 or 5 folks that are reporting to you directly, regardless of what business you're in, and I don't know much about the gym business other than being a customer. The one thing I know is that execution is all dependent on that key talent and the folks that are direct reports. And for those direct reports, it's the best class we ever took at HBS. I don't remember any of the technical classes we took, but we had a class on management, and the professor talked about incentives and structure, right? How do I get this human being or this group of human beings to do the right thing, whether it's the incentive or the structure that keeps them doing the right thing, right? So it's the controls, right? So a structure would be, weekly report. A structure would be not necessarily the org chart. The org chart really, it doesn't really do much. But how do I make sure that they're going to do the right thing when I'm not looking, when you're not looking, Roger? So I think that's the most important thing to solve for. And then the incentive piece is, if I win, how do they win, right? But it doesn't need to be 1 for 1 or 2 for 1 or whatever number. People have different formulas for it. I don't subscribe to any of those, but what matters is if I win, they win, and if I lose, am I willing to fire that person, right? The one thing I've invested in over 30 businesses as the lead investor over the years, and the one thing I wish I had done faster, always done faster, was firing that CEO or firing that. Telling the CEO to fire that CXO that they have reporting to them. That is the one mistake that I've consistently kept making over and over again, because we're all human beings, and it's a hard decision.
Are you saying that you trusted your gut, like your gut told you, or that there was something empirical that was going on that you knew?
I think that now that I have gray hair, I can say my gut. But when I was younger, it was the data. The data, the metrics don't lie. If you give them 3 objectives, and you at the start of the year or the start of the quarter, start of the week, start of the month, whatever that time period is, you say, here are those 3 objectives, and here is where we are today, numerically. Here's what I need to get to numerically, and if they don't get there, all right, you've measured their performance.
Those are great answers, great wisdom. Thank you for sharing, Roger. I do have a follow-up question, and I'm reminded of a great quote with what you just said. It's from, I think, Jim Barksdale, who I think was the founder of Netscape.
Yeah.
It said, if we have data, let's look at data. If all we have are opinions, let's go with mine. And naturally, my follow-up question is: you mentioned that your only knowledge of the gym business is as a member. I'm curious, what gyms or studios you've been a member of or have gone to, frequented in the past, and are you currently a member? What are you doing during COVID with regard to exercise? And if you're not currently going to a gym, what will it really take for you to become comfortable to work out in a gym again near other people?
So I'll give you the names of the gyms I've worked out with, and it corresponds to my net income at that time period. I started with Bally's and LA Fitness, and then moved on to Equinoxes of the world. And then, my wife loves these Solid Core and all these other places. I think COVID has changed it, right? So COVID has changed it, and Peloton has changed it. I was lucky enough, the 2 co-founders of SoulCycle, and I was recognized with them along with Kevin Systrom of Instagram. There was a bunch of us that got recognized as entrepreneurs by Goldman Sachs. This is going back 6 years ago. And so I spent a decent amount of time with those 2 powerful women talking about SoulCycle and what could be disruptive. And I came from the internet world and kept thinking there's got to be other applications. And sure enough, Peloton came and disrupted that. And I think my guess is, as I think about healthcare, as I think about gyms and working out, it's that personalized experience. But I think it depends on what stage of life you're at, and what segment of the market you're going after. From Planet Fitness versus some of the what I call the swim boxes of the world. I don't know if these names mean much to you guys, but I think there's going to be trade-off. We're social animals. We will want to go back. I want to go back to a gym. Like the one, like I enjoy being next to my office is 24/7 fitness. I want to go back. I'm waiting for it to reopen. I actually co-invested with Jim Barksdale when I was at AOL. And I just got to tell you this funny story because it was the only time in my life I invested with him. And we invested in a business called Respond.com. So we put in $5 million. He put in a couple $1 million. And then this is the heydays of the early 2000s. We go to the launch parties. So startups back like 20 years ago would have a launch party once they raised some money. And at the launch party, he came in. I was a young kid. I just graduated from business school. I come in and the party was just outstanding. They hired Cirque du Soleil and it was just impressive. And I'm looking around, I'm like, wow, this is how it's done. And Jim walks in, he looks around and he has this utter look of disgust. He comes to me and the founder of Respond comes to both of us. And he asked me one question. He said, how much did this thing cost tonight? And the guy said, only $1 million. He put his drink down and walked away. That was the end of that. But those are the glory days.
Yeah. All right, Jason, let me get the last question here of Jason and Sarah. And thanks, Mirza.
I'll make it quick.
Yeah.
First, thank you for doing this. This is awesome. You mentioned something about the whole measure, manage, monitor your people and your talent. So I'm in the lucky position occasionally I get to travel and I come in and evaluate. One of the very first things I do in a club is look at talent. And oftentimes what I'll find, and I assume from your experience the same thing, that they'll have Debbie Downer or John Doe, who's been the membership director or the fitness director for 5 years, and they don't, even though all the data says this person should be transitioned away from this role, whatever that looks like, a lot of times it's an emotional choice as opposed to a logical. They'll hang on to these people forever. So as you mentioned, in your experience, you wish you had done that faster. Is there any advice you could give me and the others? Like, how do you get vested parties or co-founders to make these decisions when data alone won't necessarily do it?
I think that's a great question because it's a problem we face constantly, even though very different types of businesses. The critical element is giving the alternative, creating that alternative. And in order to create the alternative, half my job is recruiting. I recruit executives all day long. All right. I mean, literally half my job, from a time perspective, is recruiting folks. And so whenever I meet with these co-founders, I have a list of 3 to 5 candidates that I think can do a better job than that person. So I'm going to tell them that they got to fire. And that's the only way that it becomes real. And once I give them and once we have that frank back and forth conversation, I give them the resumes and say, look, Jason, just talk to these 3 guys, or the 3 gals. It doesn't, and just the conversation alone is very helpful, right?
That's great. Awesome. Sarah, last question.
Thank you so much for being here. Your conversation around the future of healthcare is just mind-blowing and so fascinating. What company would you recommend a sales professional in the healthcare field keep an eye on? As is there a company right now that you're just super impressed with, or is it more just the digitization of workflow? Keep an eye on that. What would you recommend? So
I'll give you a group to look at, right? So at companies in healthcare, if you're looking to join in a sales capacity, I think that's what you're asking about. Would be companies that are focused on what I call value-based care, right? They're taking total ownership of that person or population. And they're popularly known as ACOs, or value-based care organizations. I think they're everywhere in the country. There were a few before, but they're everywhere. Majority of healthcare spending is going to go there. So if I was to join as a young professional or senior sales professional, I would join those. Then there are individual companies, which are very impressive on their own. Companies like HRS, if you're in New Jersey, or Oscar, if you're in New York, Collective Health, if you're in California. There's a number of these great companies out there that are killing it. the public companies, I'm not so sure about, because the question is, what's the upside versus some of the other companies that are still, still have ways to go. Thank you, Pete. Thank you for allowing
Thanks,
me the
Marissa.
opportunity.
It's great. Awesome. Really appreciate it. I'll catch up with you next week
All right,
separately.
sounds good.
Awesome. Thanks,
Thank
man.
you, Marissa.
That was
Bye.
great.
Thank you.
Thanks, Marissa.
Take care.
Man, I missed that. So do you think about like 80 people like that in a 2-year business school and just having discussions when people are getting called on, and like, this guy worked at AOL, this guy worked at, Pepsi, and this guy ran a startup, this woman did, a healthcare deal, and like all these people are in the room like we're doing here. So it's pretty awesome. And I want to thank everyone here for being a part of this. The interesting part about venture capital is he's looking about what's around the corner. He don't really care what's happening today, where the private equity firms are saying, hey, where's the cash flow? What are you going to do today? What's the next couple of quarters look like? He's got a 5-year plan and saying, here's where I know the industry's going. And I know there's going to be some really big companies here, and I'm going to help build them. So completely different investment philosophy. What's the EBITDA? What's the revenue? Don't worry about that. Like, this whole market is going to be digitized, and it's going to be worth billions and trillions of dollars. So let me go and find the right groups now that I think can get there and be part of that ecosystem. And those are going to be the groups that are going to be worth, 15 times revenue once everyone says, oh, this is actually where things are going. So he's looking at things behind the curtain, and it's fascinating. I haven't spoken to him in years. But that was pretty awesome. So let's, I want to keep on time. I want to finish up the rest of the case. When we start the case on LA Fitness, I'm going to talk about how all the guys and women at the private equity firm get paid on their promote, because I think it's important for you guys to understand how they get paid. So we'll cover that to start at LA Fitness. When we do the LA Fitness class, I want you to think about 3 things. 1, were they in the right place at the right time? 2, what was their special sauce? And 3, do they have a good business now? So Dave will post those up, and that was a great discussion. Have a great night, and I'm feeling really awesome right now. So hope you guys. That was awesome. All right, on 3, Halo. 1, 2, 3, Halo.
Halo.
All right, have a good weekend. I'll see you guys soon.
Good night. Great class, Pete.
Awesome.